What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this is a channel dedicated to my investment journey, along with coverage on Tesla, NIO, Virgin Galactic, and Chargepoint. Come for the information, stay for the fun clips. So the market decline continues and actually has intensified, reaching brand new record lows as the week went on. And if you're asking yourself, when will the big tech and high growth stock sell-off end? Well, that's the golden question. Many have actually taken this opportunity to average down. Others are panic selling. Actually, there's quite a few people panic selling right now. And more fund managers that you can count have taken this opportunity to not only rebalance their portfolios, but also take it a step further and short stocks, right? So they're cashing out their gains and waiting on a sideline now to simply redeploy once we've hit rock bottom. I'm actually interested to hear, where do you fall on the spectrum? Are you averaging down? Are you panic selling? Have you panic sold, I should say? Or are you waiting on a sideline, waiting to deploy cash once we've hit what seems to be bottom? Like, put that in the comments below. Also, as a side note, as I was going through the channel analytics, I noticed that over half of my viewers actually are not subscribed. The content does take time to put together, and if you are finding value in it, I would really appreciate it if you would subscribe and like the videos, as it does help the channel grow. With that said, today's video will have 4 parts. Part number 1 will be focused on recent news on the channel favorite stocks along with Dogecoin. Part number 2, we'll watch a video clip discussing the market current conditions. The guest speaker has a really good perspective on what's going on, and I'll add some commentaries where I see fit. In part number 3, I'll tell you where I believe we're going and why. And the last portion will wrap things up with the weekly performance review by gain or loss for the portfolio. This video will likely be on the lengthier side of the spectrum. However, there's a ton to cover, and I do believe that watching it all the way through will be worth your time. With that said, let's get into it. All right, so first up in our newsflash part of the video, the first company we're going to discuss is going to be Chargepoint. And for those of you who own the stock, you've noticed that on Monday, the ticker symbol switched from SBE to CHPT. And that's because the merger between the blank check company SBE and Chargepoint is now complete. And as expected, the stock sold off. Now, this selling off was made even more severe because of the current market condition. And at the lowest point, it dropped by 40%. Before recovering on Friday to around 26.99 cents, right? So what I want you to remember is that Chargepoint has the largest EV charging network in the US, and they are now quickly expanding into Europe. And the one thing to remember is that the current market conditions are not going to last, right? So more on that later on in the video, but the point being that they are well positioned to benefit from the Biden Green Initiative that's coming our way with infrastructure, more moves toward renewable and electric altogether. And finally, next week on Wednesday, March 11th, they're going to be holding their first ever earning call as a publicly traded company. This should give us some pretty good insight on the direction that the company is going in for 2021 and beyond. Next up is going to be Tesla. And if you recall, it was maybe 3 weeks or so ago that the stock price hit an all-time high of $900 before starting its downward trend, leading to ultimately the lowest point that we've seen in months at $546.80 this past Friday. Obviously, Tesla bears have been coming out of the woodwork, spreading more fear and uncertainty and driving the stock price down. And I don't blame them. If you consider that for the last year, it's been record highs after record highs, and anybody who has been shorting the stock or been bearish on the stock has lost a significant amount of money, right? So this is their chance to, to celebrate, party, and make some money. So can't be mad at that. But that doesn't really change anything in the fundamentals of the company. The reality is they've been making some boss moves all week. And we're going to go through a short list of the ones that kind of stood out to me. There's a lot more, but I'm just going to stick to these few points here. The first one is going to be Tesla releasing a brand new social media platform. The intent here, they want to connect with the community, the Tesla community, more directly. And so they're getting rid of all the forums and now launching this new platform that will allow Tesla community members to get more in touch directly with what Tesla is up to and the initiatives that they have in the community. The second one has to do with Tesla dropping their price in Japan. And this price drop or price cut was by 25%, which has essentially allowed Tesla to sell out of their inventory for Japan for the rest of the quarter. In Germany, we saw a 180% year-over-year increase in registration, and that translates to a 10.5% market share gain for Tesla over the competition. In addition to that, still in Germany, Giga Berlin is now getting their first GigaPress installed, and they're actually starting to manufacture the underbody or the one-piece cast for the Model Y. Next up on the list here, Tesla is rolling full self-driving beta more broadly. And so Elon tweeted that they're expecting to double the amount of people that can have access to full self-driving beta, with the goal to go even wider by summertime. And so really what's exciting here is that this is the first step towards the subscription model that Elon had promised, rolling out this year. But more importantly, as they're getting more data from more people utilizing the software, it's going to allow them to finalize the final version of full self-driving and achieve level 5 as promised by the end of the year. Additionally, we know that the UK and India government have been trying to convince Tesla to come to their country and build a gigafactory there. So it won't be long before we find out which country, maybe it's one, maybe it's both, actually gets the next site for a gigafactory. And that again is a massive move on Tesla's end. There is a lot more news that we could be going through here, but for the sake of time, the last one that I will mention is this. Earlier this week, Tesla announced that they've secured a new long-term supply of nickel from New Caledonia. And why this matters? Well, it's frankly because New Caledonia has one of the largest reserves and supplies 25% of the world's available nickel. And as Tesla continues to ramp up towards their goal of 20 million cars by 2030, this ensures that they will not have nickel as a bottleneck in their supply chain. And not only have they secured this deal, they're also a consultant to New Caledonia on the whole mining process and refining it. I mean, that's huge, huge news.
Both.
Next up on the list here is going to be NIO. And similar to Tesla, about 3 weeks ago, their stock price was at the very top around $66.99, so call it $67. And since then, we saw a steady decline, eventually cratering down as low as $32 before bouncing back on Friday. And that's over a 50% decline in the stock price when nothing fundamental has changed at NIO, and instead they're actually, again, same thing, making some boss moves. And this new venture here is what will allow them to go after the mass market. So remember during NIO Day, they've talked about creating a sub-brand that would be more affordable. Well, this is working towards that goal. And the last piece of information for NIO here is Edison Wu, who's an analyst at Deutsche Bank, reiterating his buy rating on the NIO stock price with a target of $70 by the end of the year. And this is based on the notion that NIO will deliver 90,000 plus cars in 2021, and they are not seeing any slowing down in the demand and performance of NIO this year.
Both.
Last but not least, in this new section of the video, we'll talk about Dogecoin. And if you recall in the last video that I posted, and I'll link it here, I told you guys how I believe that over time, Dogecoin would continue to gain mass adoption as the people's crypto with increased utilization. And a great example of that happened this week when Mark Cuban announced that starting in the very near future, they will now start to accept Dogecoin for purchases on merch and basketball tickets for all the Dallas Maverick games. I mean, that's big news. Currently, you can use Bitcoin, but again, as I've said before, it makes more sense to use something like Dogecoin, which is in small denominations, to make those type of purchases. The last point that I will make about Dogecoin is despite all this crazy market volatility, it's been hovering right around 5 cents this entire time. There's people who are not believers in Dogecoin. I'm definitely a firm believer in it, and I think that it's going much, much higher before the year is over here. So take it for what it's worth. The whole point of this section was to once again reiterate and reinforce the fact that despite all this short-term market volatility, these businesses are making massive moves to improve their business fundamentals. And as an investor, that's what I care about, the long-term view, not so much the short-term ups and downs that we're experiencing right now. And as long as those business fundamentals are improving, there's absolutely no reason for me to sell. And ultimately, if you consider that the world is still moving towards electrification, meaning that Tesla, NIO, and Chargepoint will benefit in a major way, and the space industry is seeing more and more interest, meaning that, again, Virgin Galactic, as long as they execute, will benefit, again, in a massive way. And finally, cryptocurrency is seeing more and more adoption, and it's about to hit overdrive. So as far as Bitcoin and Dogecoin are concerned, you're going to see those two hit record highs after record highs over time. All right, so let's switch gears now and try to answer the question around how long will this market weakness last? In this next section here, we're going to watch an interview with Brian Belski, who's the Chief Investment Strategist at BMO Capital Market, discussing his views on a current market condition and where we're going. And for context, BMO Capital Market is part of the BMO Financial Group, which is the 8th largest bank in North America. They offer corporate and investment banking, treasury management, as well as research and advisory services to clients around the world. So hearing from their chief investment strategist should be insightful to say the least. Let's play the clip.
Why are you not so worried about this bump up in bond yields that we've seen, which did seem to at least temporarily spook the market last week?
Good morning, Julie. Thank you so much for having us, and thank you for the opportunity to kind of clarify. We are not headline type of strategists. We are process and discipline strategists doing this now for 31 years and looking back at perspective and history. We're not going to pander to short-term traders or momentum traders. We're going to look at how we're going to run money for our clients. We have the very good fortune of running $5 billion in equities in Canada and $2 billion in the US. We are long-term fundamental thinkers. Through that, we have a time-tested process in how we look at things. And if you go back and look at how interest rate cycles work, not just that they go up or not just the duration of how fast they go up, why interest rates actually go up or down, and it's all about the economy. So there's a very simple equation with respect to investing. Stocks lead earnings, which lead the economy.
That's an important opening comment made here by Brian, and there's a reason why he's emphasizing the speed comment so much. And the reason for that is because the vast majority of interviews that have taken place in recent weeks, as well as publications, have been solely focused or very focused on the speed at which the 10-year Treasury bond yield has been rising and the potential impact to inflation as a result. The key word here is potential. And so it is the fear of the potential rise in inflation that has driven the market to bid up the bond yields and let the equity market side of things drop in order to hopefully force the Fed's hand in changing their monetary policies, the buybacks that they've been doing, to benefit, again, short-term investments and traders.
We have proven through analysis, and deep analysis, by the way, that stocks can go up and interest rates go up, especially from these types of levels. Clearly, we've never had these types of levels before, but we've had periods in history where the economy has cratered, where interest rates go up when the economy begins to recover. Remember, the economy is recovering, Julie, because earnings are going up and fundamentals are improving. So, of course, interest rates are going to go up. Lastly, on this whole notion of inflation, unfortunately, the majority of Wall Street strategists, economists, let alone money managers, have become excessively quantitative in economic and macro the last 20 years because they haven't trusted fundamentals. They're too deep rooted into academics and books relative to running money. And we're looking for inflation. We've been looking for inflation since 1982. I want to be very, very clear. We're not going to have inflation in this country until unemployment claims drop precipitously. You saw the ADP numbers today. We're going to have an employment situation in this country for a while, especially given all the gains that we've seen in terms of technology and efficiencies. To get sub 4% unemployment in America is going to be several quarters, if not several years away. So I think we all need to take a deep breath with respect to calling for inflation right now.
So even though I agree with Brian here at 100%, I also understand why the market, generally speaking, would want to spread that fear around inflation. And the reason why inflation is basically kryptonite for high growth stocks is because, well, high growth stocks valuations are based on future earnings. And if there's inflation, if there's high inflation, then that future earning is not going to be worth as much in the future. And therefore, when you discount everything back to today's stock price, it is not worth as much, right? And so the whole point is that large institutions had to rotate out of those stocks, right, by necessity. Again, they have to abide by certain quotas and certain percentages of their portfolio that has to be allocated to it. And in doing so, that triggered a sell-off. Now, nobody wants to see, again, that momentum, those momentum traders and everybody else capitalizing, and they don't get to benefit from it, right? So if we can get those stocks as low as possible, right, by overselling, then and convincing people that inflation is coming, then you can get that froth money out of the stocks.
Are you surprised to the extent that folks are now reverting to, well, in the 90s, this happened and it's happening again. And so the outcome will be X, right? I mean, I thought it was unprecedented. I thought we agreed on that. And now we're just running analogs on a couple market cycles.
It's a wonderful point, Miles. And thank you so much for bringing it up. These are the same people that we were not arguing with, but kind of combating in our analysis and our comments with clients around the world. We were panned across every medium, from media to clients to everything, just being bullish all the time, Belski. And no, it's not. It's common sense, part of it, Miles. The other part of it is that I think we're so afraid to be wrong. We don't want to be right in this business. We're still playing defense. And that's why we are so bullish in our call with respect to the 20-year bull market, Miles, because we're investors. We're common sense. We do the analysis instead of hiding behind historical facts that, oh, by the way, haven't worked and are not going to work going forward.
Some really solid points made here by Brian, and really all he's getting after is the fact that last year around this time, many people did not participate, right? People were afraid, they didn't know what to expect, and therefore they did nothing. Or if they did something, they did it in a small scale type of way. And therefore, when the market roared back up, they did not benefit from those gains. So now this year, everybody's trying to position themselves and benefit from as much as they can, as quickly as they can. But again, it's all that whole short-term mindset versus where's the business going? Where are the business and the companies going, not just over the next quarter or two, but over the next year, 5 years, and beyond. And those who did that last year are those who were able to capitalize on some major gains moving forward. And right now, we're seeing the same thing where people are afraid to take those steps and instead are focused on the next quarter or two and playing the inflation game, the inflation card, in order to try and limit the advance of some of these stocks so that they don't miss out on those gains.
Brian, have you made any changes to your S&P 500 target for this year since the start of the year?
We have not. We're not among these strategists that change our opinions every other day or every other week. We have published our piece in November, as we do all the time. This is our 23rd forecast in the S&P 500 as a senior strategist, and our 9th on the TSX in Canada. Our target for the S&P is 4,200. It's staying 4,200. We're at $175 earnings. We think actually both those numbers could be a little bit too low, but we always try to provide a situation in our analysis that we underpromise and overdeliver. In terms of this whole notion of the fears of the taper tantrum, I think people are getting way too ahead over their skis here a little bit. I think the Fed, and we're in line with BMO Economics clearly, that we're not going to see an interest rate change or posture from the Fed change until well into 2022.
I think that was a very eloquent way for Brian to sum that up. And because I like to simplify things even further for myself, the way I've been thinking about this whole situation here is essentially that the market is like a big toddler. It wants what it wants, and it's going to kick and scream until it gets it. Jay Powell and the central bank are more like the adult, right? But the interesting that happens when you don't give in to temper tantrums is that the toddler eventually realizes that it's not getting anywhere and corrects course. And then we saw what we were told we would not see, which was the bond 10-year treasury note in the green, as well as all three major indices. So the Dow, the NASDAQ, and the SP 500, all in the green, all going up at the same time. So where do we go from here? We'll answer that in the next segment. So here are my thoughts on where we're going from here. And before I get into them, again, remember that these are just my thoughts. They're not to be taken as financial advice because I'm not a financial advisor. But there's only a small window of time left for all these fund managers and large institutional investors to get back in a major way. If you consider that over the last few weeks, the narrative has shifted from, oh my God, inflation is coming, to, yeah, I think we're about at the right valuation, to, yes, we're about ready to redeploy our cash and get back in a major way, which is pretty much this week. That's what we've been hearing. And all of the Q4 2020 earning calls are complete, and it's been nothing but good news for a lot of the high growth stocks. Next earnings season kicks off mid-April and beyond. So that there's usually a run up before earning call. And you add to the fact that the 1.9 trillion bill is likely going to get signed off by President Biden next week. So those checks are going to start flowing to people and to the market. If you want to get back in a major way, you pretty much need to do it right about now, in the next week or two here. And since That whole narrative was all about dropping things low enough so that they can get in and capitalize on it. You better believe that it's more than likely, in my opinion, that over the next week or two here, we're going to see a leveling and then start shooting right back up. And so as far as the portfolio performance, I'm not going to run the whole graph thing because we're way over time at this point. It's been running kind of long, but we were down about 25% for the week, which brings our grand total over the last couple of weeks here to right around 35% that's been lost on a portfolio. So pretty brutal, but on the flip side, I was able to advance my NEO and Tesla positions in a major way, pretty much doubled up where we are or where I was when this whole thing started. So can't be mad at that. And for our fun clip of the week, it comes courtesy of SpaceX. And the reason I selected this, I will tell you after we watch it.
With the intention of carrying humans and 100 tons of cargo to the moon and Mars. It was the company's third attempt at a vertical landing. SpaceX has successfully landed one of its rockets in Boca Chica, Texas, at the end of a high-altitude test flight. The Starship exploded minutes after touchdown.
If you made it this far into the video, please go into the comments and let me know if you expected the clip to end in the way that it did, because I certainly didn't. But the reason why I selected it over pretty much everything else I could have gone with is because, one, I believe that this is the point in time, this is the first time that they've landed this rocket, but I believe this is the point in time that we'll look back on and all collectively say this was the one major step forward that gave us the capability for interplanetary travel. And two, because sometimes no matter how much you plan and calculate and strategize, things still blow up. And that's what we've been experiencing in the market, and you just gotta roll with it, learn and move on. All right, people, this will do it for today's video. If you're still here watching, then I'm assuming you enjoy the content, so you might as well drop the video a like. Also, if you're part of half of the viewer who is not currently subscribed, but you're still here watching, please subscribe, as this will ensure that you don't miss any future content. As a reminder, I post every Sunday and occasionally during the week. With that said, thanks again for watching. Stay humble, hustle hard, and I'll see you in the next one.